program is brought to you by Strategies for Wealth Management.
If you're looking for an easy-to-understand explanation of certain financial vehicles often found in retirement planning, but you're really confused, you've come to the right place today. Welcome to Smart Retirement. My name is Laura, and I'm joined with my husband, Michael.
Hello.
Hello.
Good.
Boy, oh boy, there's a lot to get into, and I know people, it's so confusing online.
Have we got a show for you today?
I mean, you know, when you plan your retirement, financially, specifically, you could really get overwhelmed with all the different types of vehicles you could use. I mean, there's just so much out there.
And the lingo, too.
The lingo, yes.
You've always said to me, being in the industry for over 35 years, sometimes we take for granted things we understand and we use lingo. And you've always told it to me, sometimes people don't understand the lingo. And in our business, the financial business, retirement planning business, there's a lot of lingo, financial products thrown out there, a lot of misconceptions and miscommunication.
You know, I always equate it to like when you go get your car done and like, you know, the mechanic is talking to you about your engine and you're just like glazed over. Now, some people love that, but not me. And he's telling me, and I'm just like, does it drive and am I safe, right? I can't get into all your lingo. But this is people's money, right? This is their life savings.
Definitely.
So they need to understand how things work. Now, maybe not like down to the exact wire,
right.
But I think it's important for people to know what they're invested in and what their opportunity could be.
Yeah, definitely there's a lot of misinformation, like I said, or miscommunication. And we're going to talk about 3 popular financial vehicles today, if time permits, right?
Right.
If we don't get to all 3, we'll do it on another show.
Yeah.
But we want to clear up some miscommunication and talk about annuities. What are they? How they work? And the other thing we're talking about is long-term care insurance. What is it? How does that work? And then life insurance, if time permits.
Yeah,
right?
yeah. All right, so let's get right into the big one, because this one, I mean, there's so many ads on TV that say positive and negative, right?
Yeah, a lot of opinions.
A lot of opinions. Annuities. Let's talk about annuities.
So at a live event, when we do live events, I ask the question, how many of you heard of annuities? And a lot of people raise their hands. And then I say, hey, for the next 5 minutes, we're going to do a crash course on annuities and clear up any miscommunication. And by the time I'm done, you're going to know more about annuities than most people.
Well, in all fairness, it's probably more than a 5-minute quick course, but you're just trying to give people like something to hold on to. Yeah.
Because that word is taken for granted. Look,
yes.
You know, there's a lot of misinformation about annuities. So here's what I'm going to tell you. Look, we're going to do our best today on the TV show to clear some misconceptions up. But what I want to tell you is, look, you know, we can go what we need to over the TV show. But again, it's important to meet with someone professional in the industry. But here's the thing. If someone gives you an opinion about annuities, I'm going to tell you, in my opinion, be very, very careful. Here's why. Unless they tell you the kind of annuity they're talking about, then it can mean a million different things. Because annuities is just a word, just like I go to a restaurant. I could eat at McDonald's or I could eat at Ruth Chris Steakhouse. They're both restaurants, but they're very, very different, right?
Yeah.
That's the thing about annuities.
Yeah, sometimes I think, excuse me, that people really want you to be confused, like on purpose, you know, like some of the commercials confuse you, right? So I think it's really important to get the message clear. And let's separate these different types of annuities. First, I love the fact when I first got into the business 8 years ago, when we were talking about annuities between you and myself, you told me, and this is very helpful, so listen up, everybody. An annuity really means a savings account.
Well, let's back up for a second.
Yeah.
Because here's the thing. Annuities were created by the Roman Empire. Believe it, the Romans created annuities to cover income for the warriors that died, you know, the people, the soldiers that died, for the income for the family. Okay. So annuities in and of itself is an insurance product, is the opposite of life insurance. Where life insurance, you know, someone dies as a death benefit, annuities are more what we call longevity insurance. And the original annuities were pure longevity insurance created by the Roman Empire. Now, there's actually an article. It's a brochure called The History of Annuities, and I believe we have it for everybody.
Yeah, we're gonna put it up on a landing page that we'll give to you, and we'll have a QR code on the screen, and you can go ahead and read your heart's content about the history of annuities, because it's interesting to know that it's been around.
If you're a history buff, you're going to love it. Even if you're not, you're going to love it. It's very fascinating. I love this stuff, right?
Yeah.
But if you look at it, over time, Benjamin Franklin, Beethoven, right?
Shaq.
Well, the three Bs, Benjamin Franklin, Beethoven, and
Babe Ruth.
Babe Ruth, sorry.
How could you forget Babe Ruth?
Yeah. They all use annuities in their life for financial reasons. In fact, let's bring it up to date, Shaquille O'Neal as well.
Right.
Now, they use it for different reasons. Babe Ruth has said, hey, during the Great Depression, put your money in annuities, and it protected his life savings during the Great Depression.
Yeah.
So here's the thing, there are 4 basic kinds of annuities. So let's say 4 categories of annuities.
Yeah.
And go ahead.
Yeah, no, I was going to say the first one's an immediate annuity.
Right.
And I like to think of this much like your Social Security, right? Like, in a way, it's almost a form of annuity, right? You're getting paid for your life.
Yeah, so if you're sitting at home, right, raise your hand if you're collecting Social Security. If you're collecting Social Security, let me ask you, how much did you pay into Social Security all those years? Now, when you took the income from Social Security, did the government give you a lump sum, or what did they give you? Income. And when you die, what happens to that income? Other than maybe the spouse continuing it, the income's gone.
Yeah.
That's what we call an immediate annuity.
So it's ensuring that there's enough money coming in your life to provide you some income, versus, like you said, the opposite of life insurance, which is once your life is over, your loved ones have funds that you've left for them.
Right. Well, an immediate annuity or income annuity is we give the insurance company a large sum of money, and in return they give us an income, but the money's gone. Another example is a pension.
Yes, that's a good example.
When people retire and they have a pension, usually the company gives them an option: take the lump sum or take the income. You can't have both.
Right.
So an immediate annuity or income annuity was used for that, and a lot of you have it. If you're collecting a pension or Social Security, you have it. You don't even know it, right?
Yeah, that's
one kind of annuity.
Yeah.
Now, the second kind of annuity is called a fixed annuity. And you know what? It's kind of a alternative too.
Yeah, it is. We call it a CD alternative. It guarantees you a rate for a certain amount of time, and when the time is over, you get your funds back, or you can do something else with it. Yeah.
Typically, just like a CD, it's a short-term fixed rate interest.
Yep.
Banks sell CDs, and insurance companies sell fixed annuities, and maybe you can lock one in for 2, 3 years, 5 years with a guaranteed rate of return. When it's done, you could take the money, move it somewhere else, do whatever you want. No risk, no fees, guaranteed rate.
I think one of the things that separates a CD from a fixed annuity is that a fixed annuity is tax deferred.
Yes.
Where CDs are not. So you have to pay taxes on growth, but on a fixed annuity, you can defer the growth until you take the funds.
Yeah, and anytime you have tax deferred growth, it can usually compound on top of each other and grow a bit better. So it can be a good thing, but I want to understand the basics, and the basics are CD or fixed annuity, very similar in nature, just a guaranteed rate.
Yeah.
Right?
Yeah.
So, by the way, when your annuities have fees and have risk, so far we went over 2 annuities that don't have fees and don't have risk.
Yeah.
See my point?
Yeah. Right. No, very confusing information. People think, oh, annuities are very expensive, they have risk. Not true, especially in those first two.
Now let's talk about the third one.
Okay.
The third one is called a variable annuity. Now, think of the word variable. When I say the word variable, what do you think of?
Yeah.
Right? What do you think of when I say the word variable?
Unsure, uncertainty, moving around, changing. Yeah, for sure, risk, absolutely.
So a variable annuity, actually the money is put in some type of investment vehicle, typically like mutual funds in the variable annuity. And certainly there's risk, it could go up and down. And variable annuities are known to have a lot of fees. So when you hear something about annuities that have risk and fees, they usually talk about variable annuities because they do have risk and fees.
Yeah, I had one. That was something I used. I used that vehicle years ago, and it was what was being used years ago. So it's not like I didn't make a mistake, everyone. But what's so nice about retirement planning and planning for your future is the ability to be flexible and move with the current conditions and new vehicles and things like that, being open-minded when you're retirement planning.
And then the vehicles change from time to time. They
Yes.
need to be adjusted. They need to be looked at. I would say if you have a variable annuity, maybe it's time for a review. Have a second opinion because they do have risk and fees. I got to tell you, quite frankly, I'm not a fan of those. But, you know, we don't really use them. I'm not a fan of those. And there's reasons why. I don't like risk. I don't like fees.
Yeah, and at the time, I don't think there was these other products available to us that we have. So that's the good news.
And if you read the article history of annuities, let's talk about the new kid on the block. And I say new, it's been around for 25 years. Right?
Yeah, the Romans didn't create it, but it's the new kid. Yeah.
But the new kid on the block is called fixed index annuities.
Right.
And the idea of a fixed index annuities is actually, it takes the downside risk of the market away. So with a fixed index annuities, I'm going to use my hands here.
Yeah.
When the index or market, let's say you're having an index like the S&P 500, when it goes up, you're actually sharing some of the upside. But when it goes down, you don't lose a penny of your money. Essentially, if you're insured yourself against the downside of the market, but you're still getting some of the upside, and typically speaking in and of itself, these have zero downside risk, and a lot of them have zero fees. Now, there's a time component to it, right? And there's some flexibility, a lot of different options, but we find clients love that for building a rock solid retirement because it takes the risk away.
Yeah, I think what huge insurance companies have done is they've listened to the consumer, listened to what they liked about one type of annuity, what they didn't like about another, and they kind of created this really great financial vehicle, oftentimes for a lot of people, not for everyone.
Right.
Yeah, we're making very
Depends
general.
on your situation,
yeah.
yes.
But it really is a result of the insurance companies listening to feedback and seeing what's available and really I think it's so creative that they do
It
this
is,
type
and a
of
lot
thing.
of them have different options, like if you want lifetime income, there's certain riders or options you can add on.
Yeah.
But I just want to kind of close this conversation up by saying what I started with. Look, if someone gives you an advice about an annuity and they don't say what kind of annuity they're talking about, then I'd be very, very careful listening to their advice, because we just mentioned 4 annuities. So if someone says annuities have risk and fees, of the 4, only 1 had risk and fees. The other 3 don't. So what kind are you talking about, right? So it really, you got to be careful with advice. You know?
Yeah, that's a very general statement to say annuities have risk and fees. Yeah. So we promised the audience we talk about several different kind of financial vehicles, right?
True.
So this one is maybe a little less fun to talk about than annuities, because annuities was a laugh a minute.
Right? I would say, you know, if you want to understand it more, download the history of annuities.
Absolutely,
certainly, we do a good job educating our clients about these different financial options. Some of them can be a lifesaver. You don't know what you don't know. And some of them, before you make a decision on something like that, like we said, smart retirement, find out more about it.
Yeah, all right. So now we're going to talk about the less popular, less fun subject, but one that is important to address when you're retirement planning, because, you know, things happen. And sometimes we don't know and we don't expect it. And unfortunately, my mother is a great example. I mean, she lived a very happy, healthy life up until her late 60s, early 70s, and then she became unwell. And the good news is she had this certain type of financial vehicle in place. And we have had to use it in the last couple of years, unfortunately. But it has been peace of mind for her. And I'm talking about long-term care, and specifically long-term care insurance, because you know, everybody thinks, oh, Medicare is going to pay for everything. I don't have anything to worry about. But tell our audience the myth about that and what's not true.
Let's talk about what I'm sure you've all heard the term long-term care. And a lot of people kind of connect that to nursing homes. It's not about nursing homes. What long-term care typically is a terminology called custodial care. And custodial care means help with day-to-day activities of living. So think about it. What do we do? What's the first thing you do when you wake up in the morning besides kiss me?
I don't even do that first, honey.
Shucks.
I usually brush my teeth, get out of bed and brush my teeth, or go to the bathroom.
Custodial care is help with day-to-day activities.
Right?
We get up, we walk to the bathroom. That's walking, transferring, going to the bathroom, taking a bath or a shower, eating. These are what we call typically activities of daily living.
Right.
If someone physically or cognitively needs help with these activities of daily living, and that's what they need long-term, they're on their own. Health insurance doesn't pay for it. Medicare doesn't pay for it. Medicare supplements do not pay for it. Now, certainly if someone has no money, they may go on welfare called Medicaid, whole different story here, but the idea is keep you off of welfare, right? So it's usually up to family to have help with these kind of, or spouses to help with these activities of daily living, and that's called custodial care. In and of itself, nothing covers it. And that's why, long-term care insurance does.
Yes.
But I need you to be aware of the situation first. How you decide to cover it's up to you, but awareness is the key.
I think what's important is to make our viewers aware that there's a need, there's a gap there where there's exposure to possible financial situation when and if something happens to you health related, where there's no one to pay but you, right? And now with certain types of options in the long-term care business, because that's changed too.
That has changed, yeah.
It's affordable on some level. In some situations, it can be very affordable, and sometimes it can't. But we're going to talk about that right now. So let's talk about their options when it comes to long-term care.
A few key points, though.
Yeah.
Look, this is a very high risk, high expense situation. So I'm very strategic, in our planning, and this is a very high risk, high expense situation. Risk-wise, I mean, there's a lot of statistics out there, but just one of the statistics we always show is some people 65 and over, there's a 50% chance will need some kind of care.
Yeah.
Now, care could be received in nursing home, home care, assisted living, or daycare. So I'm not saying nursing home. Most of the care starts at home. People don't wake up one day and say, I'm not feeling good, I'm checking in the nursing home. Usually it starts at home, right?
Right.
But 50% chance we'll need this kind of care in our life. And then the expense, look, nursing homes here in Connecticut could be close to $200,000 a year, $150,000 to $200,000 a year.
Yeah.
Home care could be 70, 80 grand for an 8-hour shift every day, right?
Yeah.
So high expense, high statistical risk, we're going to need it. So what are your options?
Yeah.
Right.
And the good news is there are options.
There are
options, and it's important to know those options so you can plan in a smart way, referring to my smart, and not feel nervous or worried that you're going to, wipe out everything you have. And in addition to the financial burden, there's also that emotional with the family.
Big time,
I mean, we've had that in our own families where your grandfather is watching for your grandmother, and it's very stressful on the family. And because a lot of people think I'm not going to be able to afford that. I'll just have my kids do it, or my friends do it. That's very difficult. In theory, it sounds good, but until the day comes, right?
Definitely. Let me add some input here, too.
Yeah.
As you look for solutions, my feeling is something is better than nothing. My grandfather had a very small policy, paid $100 a day for my grandmother, but what it allowed my grandfather to do is take 4-hour breaks every day to get his mind off of it, go shopping, go bowling, play cards with his friend. So something's better than nothing. Even if you could put a little safety net or cushion on it, it's better than nothing.
Yeah, right? I mean, absolutely. I mean, in my mom's situation, like I said, she was healthy and doing fine. And then, my stepfather is up there as well, and he is not in any shape to fully take care of her. And so because, we had this set up for her, she was able to get aides in the house to help. And it's actually more of a help for my stepfather in some way than with your grandfather, right?
Because it's stressful to be a
stressful.
caregiver. So there are 3 basic kinds of coverage here, and we'll go over them. Again, what is right for you is something that really you need to kind of sit down with someone and understand this. But there are 3 kinds. We're just trying to give you some concepts here today and communicate what's out there. So the first kind is what we call traditional long-term care insurance. Years ago, this is the most popular kind. You pay a small premium, have a large sum of money that if you need this care, it'll pay for home care, assisted living, adult daycare, nursing home. Now, it's kind of like your homeowner's insurance, right? You can own a house for years and years and years, pay the premium, sell your house. You don't get the money back.
You don't need it, and you don't get your money back,
right.
Which is actually usually a good thing.
It's a good
thing,
right? But you may pay it for all these years, die, and never need it. Okay, that was a small mistake, right? But traditional long-term care is kind of like that. If you don't need it, the money's gone, but you pay a small premium, a large sum of money. It is hard to get. Can be expensive.
Gotta be healthy.
Now, if you have an old long-term care insurance policy, usually those things are worth their weight in gold. You can't even buy those things anymore, right?
Yeah, it's very hard.
The business has transitioned a little bit. So there are some available right now, but you got to be healthy, and it does take some money to cover it.
Yeah, it isn't cheap. Okay, I like this one. I think this is a good one. It's our hybrid option, where it's sort of chassised in this other life insurance type product, where if you don't use it, there is cash value in the policy, and you can leave it to your loved ones. You don't lose the money you put into the policy.
And that's what people didn't like about the old ones. Traditional is use it or lose it. So what insurance companies have done is they actually combine life insurance and long-term care combined together. There's many different options on the table depending what you're looking for, but the concept is if you need long-term care, there's money to pay for long-term care. Right? They're going to give you the money. You choose where you want to receive
Which
the
is
care.
a nice thing, yeah.
But if you die and never needed it, there's a tax-free death benefit left to your beneficiaries. So either way, it's going to pay out.
Yeah, and it's not quite as stringent to get approved, right?
It's not quite as stringent.
A little easier to get approved. It still requires some money up front.
I'll tell you where we've seen a lot of success is some people have old life insurance policies that have cash value to them.
Yeah, that's good.
And a lot of times, because the business has changed, you can take those old cash value life insurance policies, depending on the situation, and upgrade someone to a policy that does have long-term care built in and still keep the death benefit.
Yeah, so you're, in a sense, repurposing the money that was in the life insurance policy because maybe it doesn't suit your lifestyle anymore. Upgrade, repurpose. I love that. That's
again,
a good option.
everybody's individual. You got to take a look at it. But anyways, and then the third kind is what we call asset-based long-term care. Oftentimes, just like the last thing we talked about, annuities, some annuities that have an income component to it, like a rider that covers lifetime income, some of them will sometimes give you more income, sometimes even double the income if you need long-term care.
Yeah. And most states do allow that. There are some states that are a little, they don't. Connecticut in particular was more recent. But in most states it is available where they'll oftentimes double the income that they were going to give to you to help offset some. Again, like you said at the top of this, when we were started talking about long-term care, something is better than nothing.
Right.
It is not going to replace traditional long-term care.
No.
Hybrid,
it's a cushion.
It's a cushion. It's a cushion. Trying to create a cushion for your future.
Just one thing I want to say about those ones that are income-based is oftentimes there's no health requirement.
That's a nice
and
thing.
It doesn't cost a whole lot to even add it. So usually that's a good way to put a little bit of a supplement or cushion on it.
Yeah.
So again, there's a lot of options out there, but we're just trying to clear some up.
I like breaking things down for our viewers, and keeping it simple for you because this can be overwhelming and emotional. I mean, it's really hard to think, oh my, I may need long-term care insurance, but I've seen it with my own eyes. I've seen people in my family, and I've seen clients, who have had to. Actually, you've been doing this for a long, long time, and we get phone calls, from people who had this product for 20 years. Now they
need to use it.
Now they need it, and they thank you for doing it because it's a life. It really is. Like I said, it's actually a lot of times more for your family than it is for the actual person.
It is. And my best advice too is talk to your family about this.
I think that's a good idea.
Because I've seen you with your mother and your brother and sister. I've seen some little...
Keep it good, honey.
No, I see some little ripples in the relationships because of that. So talk to your family, and really have a plan. And if this is part of the plan, great. But it's important to at least bring up the subject.
Yeah, the uneasy. Sometimes you have to talk about things that aren't so easy to discuss, but it's really important for the future.
So I think we have time for the last one.
Yeah, which is wonderful because this is another topic and another vehicle that is used in retirement planning a lot of times for people. Yeah. And maybe you don't understand what you currently have, or maybe you want to know more about what there's available. So I'm talking about life insurance, which, like we mentioned, annuities is kind of the opposite of life insurance. Life insurance can be used for many different things, and there are more than one kind of life insurance.
There are, and when we were preparing for the show and we're writing our notes, one of the things I see people all the time say is I could get term or whole life. Actually, that's not. I want to clear some things up about that and talk about what kinds of life insurance there are out there and the reason for life insurance. Most people realize life insurance is there for a risk where if you die, you leave your loved one a death benefit.
That's tax-free.
That's tax-free.
Which is very nice.
But there are many uses for life insurance that you may not be aware of. And I think it's really important, why do you need life insurance or do you need it?
Yeah.
The most popular type of life insurance that people are familiar with is term life insurance. And term life insurance, think about that like if you're renting a house or renting an apartment. That's what term life insurance is. It is the least expensive way to buy life insurance on a short-term basis for a specific need. Oftentimes we'll find younger families. They buy this house. They have a work, whether one partner or both partners are working, they know if they die, they're left with this huge mortgage on their house, or they have college education issues for the kids. And they're like, if I die, I don't want to leave my family in a really bad position. So they buy term life insurance. Let's say it's a 20-year term policy. The idea is I'm going to have this policy for 20 years. It's the least expensive way to get a large death benefit for a specific period of time.
Another way I've seen term used is sometimes employers offer it to their employees as an added benefit. And sometimes they allow them to continue even after they leave, or sometimes it's completely over. But a lot of times when people say, oh, I have life insurance, I have whole life insurance from my employer, that's probably not accurate. It's usually a term type of policy where while you're at the employer or as part of your benefit package, you have this added extra benefit.
And so think of term as a temporary life insurance. You can buy 10, 15, 20-year term policies, but after the term is up,
it's over.
The idea is really tough. Now people don't know this. Legally, the insurance company has to provide you kind of a way to continue it, but it will jack the price up so much that you won't be able to afford it. Do you know why they do that, by the way?
I don't think that's probably a smart move. But
why? Do you know why they do that?
Why?
I mean, I'm going to be a little morbid here. I apologize in advance. But let's say someone's in the last year of their term life insurance and they get hit with a terminal illness. And maybe they are given 6 months or a year to live and their term's going to be over. Legally, the insurance company has to give them a right to continue it, but the premium's so astronomically high, you would never want to. But in that situation, it'd be worth it, right? So that's why they do that.
Gotcha.
But so the idea is, if you got a 20-year term, you got to think about you're renting it for 20 years.
Yeah, once 20 years is over, you're probably not going to renew it because it's not going to be affordable, and it's not. There's nothing to take away from it. You rented it, you don't own it.
Right, but maybe the reason you bought is gone too. Your kids are grown.
That's right.
The house is paid off.
Right.
That kind of thing.
Exactly. Okay.
Now let's talk about the other kind of insurance. It's often called whole life. It's not whole life. It's called permanent insurance.
Right.
And permanent insurance has equity to it. Like you own a house, you're going to grow some cash value. Now there's many, many different types of permanent insurance. Whole life is what everybody says, right? Whole life is one kind. Variable life insurance, index life insurance, universal life insurance. So there's many different kinds, and it relates to how the cash value is going to grow.
Yeah, and I mean, the biggest thing about permanent insurance is there's a cash value associated with it.
Right.
So there is money
so you
in
own
this.
equity in the account.
You own it, and there are things you can use it for, against it, and it can get really complicated. Again, you really do want to talk to somebody who's a professional. We're giving you a broad overview of the different terminology, the mumbo jumbo that you may be hearing.
Yeah, some people may want to buy permanent life insurance because they always want their life insurance. Some people use permanent life insurance as a cash value opportunity to grow the cash value tax deferred and take a loan against a policy to take some of the money out tax-free. Many different ways to put this together. It does need to be put together based on the goals of the money, but I think the important thing to know is you have term, which is temporary, or permanent, which like you own a house, you own equity in the account.
Yes, and also usually with a permanent insurance, there is an underwriting that you have to go through, and getting it, you have to. It's somewhat of a process. It doesn't happen immediately. Oftentimes, it could take 4 to 8 weeks to actually get it and go through the process. A lot of times, I'm just.
Well, with all life insurance.
But especially.
But sometimes with permanent,
it's a little bit more strict. So I just want to. Well, I think we've hit everything.
We have. I mean, look, there are a lot of people who own life insurance. They don't even know what they own. And I ask, and I think it's important, again, smart retirement, right? Know what you own, understand it, but also examine it. Is it right for today's situation? Because things adjust. The world's changed. We watch movies have changed. We listen to music has changed. I mean, everything's changed.
Everything's changed.
Yeah.
And our job is to keep everyone up to date about the changes so you can have a great retirement no matter what that is. Hey, I hope you enjoyed today's show. I hope you found it helpful. I know that Michael and I love discussing this. We're passionate about it, and we enjoy spreading this information. So anything else to say, honey? We're good?
We're good.
All right. Thanks, everybody. Have a great day. The preceding program was brought to you by Strategies for Wealth Management.
Nutmeg TV has been providing community television for over 30 years. We needed some studio upgrades, and Ion Bank believed in us. As a result of Ion Bank's financial help, we've been able to help others move on in a field that's difficult to get experience in. You're working with partners who understand who you are, and Ion Bank does that. They walk with us every day. It's community banking at its best.
follow us on Instagram at nutmeg.tv.